£25,000. That's the number most people think of as the safe limit for cash savings in the UK. Keep it under that, and HMRC won't bother you. That's the received wisdom, and most people I speak to believe it without question. But here's what the maths actually shows. If your bank is paying the best easy access rate right now, around 4.9%, then £25,000 earns you £1,225 in interest over the year. Your personal savings allowance as a basic rate taxpayer is £1,000. That means you're £225 over the line, and HMRC will take 20% of that excess. That's £45 leaving your account quietly, without a single letter arriving at your door. Now, £45 might not sound like much, but that number grows every time interest rates move. And if you're sitting on £40,000 or £60,000, which plenty of people nearing retirement are, the extra tax can run to hundreds of pounds a year. The reason most calculators get this wrong is that they're looking at your balance. The actual trigger is your interest rate. Those are two completely different numbers, and confusing them is what catches careful savers out. If you've worked hard, saved diligently, and you don't want HMRC quietly taking an extra slice of that money, stick with me for the next few minutes. I'm going to show you the exact numbers, explain the mechanism behind them, and give you a simple framework to make sure you're not paying a penny more tax than you owe. Subscribe if you haven't already. This one is worth your time. Let's start with the basic rule, because it's simpler than most people expect. As a basic rate taxpayer, you get a personal savings allowance of £1,000 per year. That is the amount of interest you can earn before any tax is due. Not £1,000 in your account, £1,000 in interest. At the current top easy access rate of 4.9%, that allowance runs out once your savings reach £20,408. At exactly that balance, earning exactly 4.9%, you hit the £1,000 ceiling. £1 more in savings, 1 penny more in tax. Now watch what happens when the rate changes. At 5%, the same £1,000 allowance is used up at £20,000. A slightly lower balance triggers the same outcome. But drop the rate down to 1.5%, which is what many high street current accounts and older easy access accounts still pay, and you can hold £66,667 before hitting that ceiling. Same allowance, same tax rule, 3 completely different danger lines. This is the thing most people miss. They think of the threshold as a fixed number stamped into tax law. It isn't. It moves every time interest rates move. When the Bank of England raised rates sharply from 2022 onwards, millions of savers crossed that line without doing anything differently. The balance hadn't changed. The rate had. And that's not a minor technicality, that's the entire mechanism. The government collects more tax from savers in a high-rate environment without changing a single rule. Your savings didn't grow, your tax bill did. I used to think the key was just keeping my balance under £25,000. It sounded like a sensible rule of thumb, and I repeated it for years. But when I actually looked at the rates on my own accounts, and I mean really looked, checked the statements, added it up, I realized the balance was the wrong number to watch. It was the rate that mattered. That shift in thinking changed how I structured everything. So what do you do with this? First, stop thinking about whether your balance is too high. Start thinking about whether your interest is too high. Those are different questions with different answers. A higher rate taxpayer has a personal savings allowance of only £500. If you're in that bracket, you hit the threshold at just £10,204 at 4.9%. That's not a large amount of money by retirement standards. And if you're an additional rate taxpayer paying 45%, your allowance is zero. Every pound of savings interest is taxable from the first penny. The practical question isn't, how much cash should I keep? It's how much interest am I actually earning, and how does that compare to my allowance? Most people have never sat down and worked that out. They assume they're fine because the balance looks manageable. But the balance is almost irrelevant. It's the interest that HMRC counts. so you now know the trigger. But there's a second layer to this, a protection problem that has nothing to do with tax, and that even careful savers often overlook entirely. There's a second problem that lives alongside the tax question, and it catches people who think they've been careful. It's about how much of your cash is actually protected if something goes wrong. The Financial Services Compensation Scheme, the FSCS, protects up to £120,000 per person per banking licence. That limit came into effect on the 1st of December 2025, and it applies not to individual brands, but to the banking licence that sits behind them. This is the part that surprises most people, because several of the UK's biggest banks share a single licence across multiple brands. Lloyds Banking Group includes Lloyds, Halifax and Bank of Scotland, all under the same licence. NatWest Group covers NatWest, Royal Bank of Scotland and Ulster Bank. HSBC and First Direct share one licence. So if you have money spread across what feel like 3 different banks, you may in fact have it all under one licence. Let's put some numbers on that. Suppose you're a retiree with £120,000 in a Lloyds account, £120,000 in a Halifax account, and £120,000 in a Bank of Scotland account. You might feel you have £360,000 protected. The reality is that only £120,000 of that total is covered. The other £240,000 sits outside the protection scheme. If that bank group ran into serious difficulties, you'd be in the queue with other creditors for the unprotected portion. That's not a theoretical risk, it's happened before, and it will happen again eventually. There is a temporary exception worth knowing about. If you've just sold a property, received an inheritance, or had certain life events, the FSCS will protect up to £1 million for 6 months. After that, the standard £120,000 limit applies. So if you've recently come into a large lump sum, you have a window, but it closes. The fix is straightforward. Check which brands share a licence before you spread your cash. The FSCS register is public and easy to search. If you have more than £120,000 in cash savings, which many people approaching retirement do, you need to distribute it across separate banking licenses, not just separate brands. Now you have 2 problems identified, a tax trigger that moves with interest rates and a protection limit that many people are unknowingly doubling up on. The good news is that the same framework solves both. If you have more than £120,000 spread across banks that share a licence, you might think you're safe, but you're one bank failure away from a real shortfall. So what's the framework that handles both the tax problem and the protection problem at the same time? Once you understand both problems, the fix becomes logical. You don't need to keep your balance below some arbitrary figure that someone told you years ago. You need to know 2 specific numbers, your actual interest rate and your total savings, and then do one simple calculation. Here is how it works. Step 1. Find your interest rate. Not the rate you vaguely remember from when you opened the account, the rate that's actually being applied right now. Log in to your online banking, look at the last 3 months of statements, and find the exact number. It takes 10 minutes. Step 2. Multiply your savings by that rate and divide by 100. That gives you your annual interest. Then compare that number to your Personal Savings Allowance, £1,000 if you're a basic rate taxpayer, £500 if you pay higher rate, nothing at all if you're additional rate. Step 3. If your interest is over the allowance, the next move is to put the excess working in a wrapper where the interest is tax-free. A cash ISA. Or premium bonds, which don't pay interest in the traditional sense but pay tax-free prizes, are backed by the Treasury and allow you to hold up to £50,000 per person. Let's run the numbers on a real example. Take someone with £50,000 in savings. If their account is paying 1.5%, still common on older easy access accounts, they earn £750 in interest. That's under the £1,000 allowance. No action needed, nothing to report to HMRC. But if the same £50,000 is in a modern account paying 4.9%, that's £2,450 in interest, £1,450 over the allowance, and a tax bill of £290 at the basic rate. Same person, same amount of money, same bank account type. The only thing that changed was the rate. I'll be honest, the first time I sat down and did this properly for my own accounts, I had to look up the rate on 3 different accounts. I'd been letting them run without paying attention to what was actually being credited. It's a small admin job, maybe 20 minutes, but it makes the difference between a surprise tax demand and a clean picture. Once you have that picture, the adjustment is simple. If your interest is over the allowance, open or contribute to a cash ISA and move the excess there. If you're over the FSCS limit on a single license, move the surplus to a different banking group. You're not doing anything complicated. You're just making sure the right money is in the right place. Now, I know what some of you are thinking at this point. You're annoyed. You've already paid tax on this money once, when you earned it, and now the same money is being taxed again on the interest it generates. That frustration is completely understandable, and I want to address it directly. You worked for that money. You paid income tax when you earned it. You saved the rest, carefully, over years or decades, and now the system wants to tax the interest on money that's already been taxed. I completely understand why that feels wrong. It does sting. But here's the reframe that I think genuinely changes how you approach this. The Personal Savings Allowance isn't a punishment system, it's an allowance. The government is saying, the first £1,000 of interest is yours, no questions asked. You don't fill in a form, you don't report it, it just belongs to you. The moment you go past that, you haven't been singled out or penalised. You've simply walked past a tax-free wrapper that costs nothing to use. The cash ISA exists for exactly this reason. The interest you earn inside a cash ISA never touches your personal savings allowance and is never taxable, no matter how much it is or how long you leave it there. The wrapper is free. The annual allowance is £20,000. Most people with savings over the threshold have room to use it. They just haven't got around to it yet. I don't know every detail of your individual finances, but I do know that the single biggest difference between savers who act on this and savers who stay frustrated is that mental shift from feeling cheated by the rule to seeing the allowance as something you can fully use. Once you stop being angry at the system and start using the tools it offers, the calculation becomes quite straightforward. The anger is understandable. It's also expensive if it stops you from acting. Because while you're sitting with money in an unprotected taxable account feeling hard done by, the solution is sitting there doing nothing. Once you're past that, the action steps are genuinely simple. Let me walk you through exactly what to do. Let me give you 5 things you can actually do starting today. None of them require a financial advisor, none of them involve complicated products, and most of them can be done in an afternoon. Action 1. Calculate your real interest income. Go into your online banking and find the interest credited to each of your savings accounts over the last 12 months. Add them together. Compare that total to your personal savings allowance. £1,000 for basic rate, £500 for higher rate. If you're over, you have a number to work with. If you're under, you're fine for now. But keep an eye on it, because the rate your bank pays can change without much notice. Action 2. Open or top up a cash ISA. The annual allowance for 2026-27 is £20,000 per person. Interest inside a cash ISA is completely tax-free and doesn't count towards your personal savings allowance at all. If you haven't used your allowance this tax year, this is the most direct fix available. And if you're over 65, this matters even more. The government has confirmed that those over 65 retain the full £20,000 cash ISA allowance even after changes planned for April 2027 that affect younger savers. Use that allowance now while the rules are clear. Action 3. Consider premium bonds for the next tranche. National Savings and Investments premium bonds are Treasury-backed, completely safe, and the prizes you receive are tax-free. You can hold up to £50,000 per person. They don't guarantee a fixed return, but the tax-free nature makes them a reasonable holding for money sitting above your personal savings allowance threshold. Action 4. Check your banking licenses. Before you pat yourself on the back for spreading money across multiple banks, make sure those banks are actually on separate licenses. The FSCS register is freely available online and shows you exactly which brands sit under which license. If you have more than £120,000 in total cash savings, and you're approaching or already in retirement, there's a good chance you do. Map it out and make sure you're not doubling up. Action 5. If you're a single retiree, be more aggressive about using ISAs and premium bonds. A couple can hold £40,000 per year in cash ISAs between them and up to £100,000 in premium bonds. As a single person, you have half those limits, so you need to use them more efficiently and prioritize filling them each year. Now, you might be wondering whether it's worth moving money into a cash ISA if the rate is slightly lower than your best easy access account. That's a fair question. Cash ISA rates do sometimes lag the top easy access rates by around 0.3% to 0.5%, but for a higher rate taxpayer, the maths tips clearly in favor of the ISA. You lose a small amount on the headline rate and gain the full tax saving on every pound of interest above your allowance. For basic rate taxpayers, the decision is closer, but once you've used your personal savings allowance, the ISA tends to win on the after-tax return. So there are your 5 steps. The question is which one you start with, and the answer is almost always the same: step 1 first. Get the number before you move anything. Let's bring this together. There are 3 numbers that matter when it comes to cash savings in retirement. Your interest rate, because that's what actually triggers the tax, not your balance. Your personal savings allowance, because that's the free zone, and you want to stay inside it or wrap the excess in an ISA. And your FSCS limit, £120,000 per person per banking license, not per brand. Get those 3 numbers right, and you won't leave money on the table. And you won't be exposed to risk you didn't know you were carrying. Cash is not the enemy here. A lot of personal finance content makes people feel that holding cash is somehow naive or wasteful. It isn't. Cash is safe, accessible, and an important part of any retirement financial plan. You just need to know the 2 numbers that matter: your interest rate and your FSCS limit, and structure your savings around them. That means a slightly different account structure than most people currently have. It means 10 minutes with your bank statements. It means one conversation with yourself about whether your cash ISA is topped up, and whether your money is sitting under the right license. That's not a big ask for what it protects. If you found this useful, there's a simple thing you can do right now: subscribe to this channel. I publish videos every week to help people in and around retirement structure their money so HMRC doesn't take more than its fair share. No jargon, no products to sell, just the numbers worked out plainly. Take 30 minutes this week, run through the 5 steps I walked you through, and you'll know exactly where you stand. No surprises, no tax bills you weren't expecting. I'll see you in the next one.